Welcome to the first video in our series designed to make you an expert in all things premium financing. I know that's a big claim, but I have trained thousands of advisors, attorneys, CPAs over the years, and I'll be sharing everything I know and have learned over my 25 plus years in this business. Throughout that journey, my roles have been in advanced markets, product design, and various sales and management roles, including Director of Premium Financing for a major carrier and National Sales Manager for the largest and one of the first premium financing vendors in the country. But most importantly for you, I've closed hundreds of cases and over $100 million of target in financed premiums. Today, actually, I still go point of sale, so know that I'm not one that just teaches. I actually practice what I teach. This is just the first of over 20 videos covering everything from case design, carrier selection, overcoming objections, developing centers of influence, and much, much more. Basically, it's everything you need to help you see more qualified prospects and close huge cases. Now, this series is unique in as we share all of our tips and secrets openly to help make you a premium financing expert and, at the end of the day, a better advisor. So you will hear from me, attorneys that place premium financing cases that we've worked with over the years, and other successful advisors, in addition to other experts. So let's get to it. Today we're covering what is premium financing, where it's used, and finally, how is it done? First, let's talk about what premium financing is. Whenever a client is faced with a large purchase, let's say whether it be a house, commercial property, business, car, plane, etc., how do they fund that purchase? Typically, they finance it. Now, why is that? It's because they recognize the benefits of using leverage. Using somebody else's money, in this case of banks, to make the purchase so that their money stays invested in their business or investments. With historically low interest rates right now, it's the perfect time for clients to finance their policies. A simple example I use when I explain leverage and how it applies to premium financing is buying an investment property. Let's say the client has $1 million to invest and they buy a $1 million building cash. They pay that out of pocket. Let's say the property goes up 10% in value. Well, then the client is up $100,000. Not bad. But now, let's take that same $1 million and instead of buying one property of $1 million, let's buy a $10 million building. What we'll do is put down $1 million and finance the rest. The building goes up the same 10%, but now the client is ahead $1 million. But since we borrowed $9 million, in this example at 4%, interest due to the bank would be $360,000. So in this example, the client would be net ahead $640,000 after paying interest to the bank and $540,000 more than if they were just paying cash. If the client paid cash in this example, their return on investment, as we all know, would be 10%. That's a simple math. But in the finance scenario, the return on investment, or IRR, would be 64%. This is the power of financing and leverage. Why should the purchase of a large life insurance policy be any different than their other large purchases? I'm here to tell you it isn't. Instead of the client paying premiums out of pocket from their current cash flow or having to liquidate investments, they simply borrow the premiums from a bank and just pay interest like they do with all their other large purchases. This allows them to use their bank's money instead of their own to fund the policy. Now you may ask, how does the bank get paid back? That's a common question, and you should ask it. The answer is, in rare instances, what we do is design the policy to pay the bank back at the death of the insured from the death benefit. This is known as a recover at death strategy, but only a couple of carriers still allow this type of design. In all other cases, the loan is simply paid off from either cash surrender value in the policy or other outside assets. Now that we've talked about what it is, let's talk a little bit about where it's used. As we've already discussed, premium financing is for large life insurance policies. But who is the ideal client? And what type of policies can be used, and with what type of strategies? First, clients need to be high net worth, over $5 million. They also have to have the ability to pay interest and post collateral. Now, collateral can come in many different forms, as long as it's liquid in nature. Now think CDs, securities, cash surrender value in life insurance policies or annuity policies, even a letter of credit. Please keep in mind, qualified money can never be used for collateral. As for the borrowers, they can be either an individual, a company, or a trust. As a side note, if you work with any companies that are C Corps, give us a call. We have a program where the executives can take money out from the corporation tax-free and turn that into tax-advantaged income. That's outside the scope of today's video, but it does give you a little glimpse of things being covered in depth in videos later on in this university. People always ask, can I finance universal life, index universal life, whole life, second to die? The answer is yes, all the above. Whether it's an IUL for tax advantage income, a whole life for a buy-sell, a universal life for a key man policy, or a second to die for an estate plan, premium financing can be and is used all the time. On a recent case that we've funded, the client is paying $250,000 in interest for 10 years. In year 12, we're paying off the loan with policy cash value. Then they're projected to get $3.5 million in tax-free income annually for 30 years. That's $2.5 million in total outlay for $105 million in projected tax-free income. Now that's a 42 times on cash in versus cash out and a projected 14% internal rate of return. That is the power of premium financing. Maybe it's time we start talking to clients about using life insurance structured with premium financing as an alternative asset class. Do you have any clients worried about current stock market volatility or the fact that we're on an 11-year bull run right now? Now think, if there was only a way to generate tax-free income using somebody else's money, all with no market risk, can you think of a strategy that might fit that bill? Bottom line is, if your client has the need for a large life insurance policy, I would suggest you present premium financing to them. Because at the end of the day, if you don't, somebody else will. Now that we've talked about what it is and how it's used and where it's used, let's take a few minutes and talk about how it's done. Now, traditionally, the way a client pays for a policy, as we all know, is for the client to write a check for the premium out of their current cash flow. But why would a client write a check for a $200,000 premium when we can show them how to put that same policy in force with a check of just $8,000? Now that $8,000 pays for the interest since the bank is paying the premium. So how does it work? First, the client applies for the policy as you normally would. Once you get the offer from the carrier, you then apply to the bank. The bank approves the loan and issues a term sheet. The client then signs the term sheet and the bank issues loan docs. Once loan docs are signed, the policy then goes to issue. The bank sends a collateral assignment form to the carrier, and that must be recorded and returned to the bank. An assignment form or security control agreement, depending on what type of collateral is being posted, is also sent from the bank to wherever the collateral is being held. That also must be executed and returned. Now, once all that happens, the client then simply makes the interest payment to the bank, and the bank wires the money to the insurance carrier to put the policy in force. This entire process can be done in as little as 60 days, but most take 90 days to 120. Some even longer, depending upon if multiple trusts are involved or how complex the estate plan is. It's important to understand that when submitting a premium financing case, additional requirements will need to be provided, such as a financial statement or current personal financial statement signed by the client, the carrier premium financing disclosure, signed premium financing illustrations, etc. Don't worry, our case managers are here and available to help you put those items together and submit your case if needed. Once you have the offer from the carrier, we then submit the case to the lender. We have to wait until we have the formal offer so numbers don't change. To submit to the bank, we need the following: personal financial statement, 2 years of tax returns, signed illustrations. We also have to run the illustration at guaranteed rate for bank collateral calculation, copies of statements for the collateral account being posted, a credit application signed by the client, and copies of driver's licenses for all parties involved with the transaction. Again, our team can help with this as well. So today we first went over what premium financing is and how it's a powerful strategy used to supersize cases. We then talked about where it is used with the right client. Now they have to be at least a $5 million in net worth. We also talked about the types of policies used: universal life, index universal life, whole life, and what strategies they're used with: buy-sells, key man, income designs, estate plans. And finally, we went through the process of funding an actual case and how you have a team of experts here to help you through that process. The bottom line is we're here to help. As you are on this journey to become an expert in all things premium financing, if you have any questions or if you have an actual case you want to discuss, please give us a call.